Hey everybody, Darren Rhodes here with Utah Mortgage Pros. I hope you're well, and I appreciate you taking a little bit of time today out of your busy schedule and spending it with me. We'll try and make this a really good use of your time. At the end of this little video, what we are hoping is that you'll have some knowledge that will help you save money, because in the end, that's what we're all about, is saving you money. And over the years, I've discovered that most clients, if they have a little bit of information, which I'm going to share with you today, about how to approach their mortgages, that they will be in a position to save the most money. And there's three pillars to these, which I will share with you momentarily. So before we get all into it, let's go over the disclaimer stuff. There's myself, my business partner, Eric Halliday. Eric Halliday and I have been business partners for years and years and years, too many to count. And Rachel, who is a great member of our team, been with us for a number of years. She's amazing. But just for the record, for disclaimer purposes, all the information in here does not constitute, of course, a loan or loan approval. You'll want to apply on your own and get your own scenarios. Everybody has different scenarios, and not all scenarios apply. So if you have any questions about your own personal scenario, let's chat and let's see what kind of results we can come up for you. Now, one thing that I have discovered, and that is every person that I've ever met that gets involved with a mortgage one way or another, ultimately and eventually ends up at a 100% mortality rate. So, just keep that in mind. All right, so let's talk about the three pillars. Let's jump right in here. What are the three pillars of saving money on your mortgage, or using your mortgage to help you save money in your own personal life? Well, those three are the right cost, the right term, and the right product. If you get those three right, then your chances of saving money are very good. Your chances of saving the most money. And I found that if somebody has a mortgage situation that they don't like, it's usually because one of those three is out of whack. So with these three pillars, when you get them in line, I found that they can be life-saving. And let me just relate a quick story. So a few years ago, I had a client that called me and said, Darren, I really want to buy a house. I think I'm in an okay situation, but I got some concerns, and I'd like to chat with you if you've got a few minutes. So he and I sat down and met, and we started going through the scenarios. Well, as it turns out, this individual actually ended up having some major medical issues in his family. And though he was hardworking and he had tried to put as much money away as he could, he just could not get ahead. And there was nothing he could do to get to where he wanted to be. It seemed like the financial world was working against him. Well, he had happened upon just a little bit of money because of some equity that he had in his house. And so what we did was we went through the equity that he had. And honestly, it was not a ton of money. It wasn't to the tune of $300,000 or $400,000. It was really just to the tune of about $30,000, which is a lot of money, of course, but it was not the amount of money that you would use to completely pay off a house or anything like that. But we started examining all of the different medical debts. We examined some of the other debts, and we examined what his current mortgage rate looked like. And as we went through each one, the way started opening up. We could see that, hey, if we put this money against this debt and put this money against this debt, and we refinance the house into this kind of loan with this term and the right product, well, in the end, he walked out of that. It took us about 45 minutes to go through everything. But I'll tell you, in the end, I got the warmest handshake, and he went whistling out of the office. And it dawned on me that guy had been under the weight of this burden for years, and now he actually saw a light at the end of the tunnel and a way out from under this burden. And he viewed it not only life-saving, but it was a gift. And often the equity in our homes is a gift. We bought our home a few years ago, for example. You may have bought your home a few years ago, and now it might be worth much more than what you paid for it, and you really didn't do anything other than buying the house to maybe make it worth more. And so the equity you have in your house can be a gift, and a lot of times we can make that gift work in your favor and not against you. And in some cases, I have found it seems to be even life-saving, I should say. Okay, so pillar 1, getting the right cost. So what is the right cost? The right cost means structuring your interest rate and closing costs together on a new mortgage to your advantage. Not the bank's advantage or not somebody else's advantage, but to your advantage. How does this work? Well, if you get the right interest rate and closing cost combination based on your scenario, then you may have the greatest chance to save the most money. So we look at your plan, we look at what your needs are, and we look at the given market situation, what the market has to offer, and we put those together. But the right costs and the right interest rate actually work hand in hand, and getting the combination of those two right can really save you money. Now, the question is, are there costs associated with getting a new mortgage? I hear from many clients, Darren, I hear all the time on advertisements or whatever about a no cost or no closing cost mortgage. Are those for real? And the answer is yes and no, but there are always costs on a mortgage. The secret is knowing what they are and how to get them paid. Okay? So let's start out with the very best rate. So how do you get the best interest rate, and what is the best interest rate? Well, I don't want to talk about how to qualify for the best rate because that is a different topic of the day. We could spend all day going over that. So what we're going to approach this as if you are needing to get a refinance right now, or you want to purchase a home right now, and your credit profile is what it is. So we want to talk about how do you get the best rate based on what the market has to offer for you at the time. Well, there's a lot of different lender structures out there, and they can be confusing, honestly. I have a lot of clients that say, hey, this is kind of confusing. I hear of retail bank outlets, my credit union, there's mortgage banks, and there's also brokers. And what are all these, and how do they, how can they work in my favor? Well, from my experience, mortgage brokers typically have the lowest rates. And why is that? It's because mortgage brokers are usually smaller operations with lower overhead, not always, but usually, and they're tied into wholesale channels. For example, at our brokerage, we have many large lenders that deal in the wholesale world, and they give us their loan products at wholesale rates. And in fact, the pricing that they give us on their products is usually quite a bit less than what they offer their own products through some of their retail outlets. So the wholesale channel does make a difference. And the layers of overhead usually with brokers, again, not always, but the layers of overhead can be quite a bit lower. And so the wholesale side, the lower overhead, just passes savings on to you. Now, here's a really cool situation or a use that a broker can help you out, and that is a broker will do the shopping for you. So it's important to shop, but the broker can do that for you. So you can chill knowing that the broker is going to be looking at all the scenarios, all the lenders, and see who's got the best price in the wholesale market, and then pair you up with the right product at the best price. So that's actually a really cool thing. So you don't have to go out and spend all your time, talking to everybody and getting estimates that can be confusing at times. I totally get that. Let brokers like us take care of that for you. But here's another advantage to that is brokers can also shop out mortgage insurance and other niche programs. So if a client comes to me and says, Darren, I think I should qualify, but I've got a couple of situations in my personal life where it might make it hard for me to get a normal loan. Well, I'll tell that person, hey, you know what? Let's see what lenders are out there and what we can pair you up with. And it ends up working out often quite well. Okay, so what are the closing costs? Let's just hit those really quick. There are two kinds of costs. I call them hard costs and soft costs. Your hard costs are your fees, and your soft costs are your prepaid or your escrow account. So your hard costs are the fees that are paid for the service of getting the financing package. Okay. So if you're not getting a new mortgage, you won't have any of these fees. It's all associated with the new mortgage. So things like bank charges, credit reports, appraisals, title work, all the verifications. There's employment, there's IRS verifications, flood zone, those types of things. And if you've got upfront mortgage insurance, that type of stuff. So there could be more fees than that, but it's anything that's associated with that new mortgage. Okay. Now, again, if you keep your old mortgage, then you're not going to pay any of those fees. The soft costs are costs that are incident just to owning a home and not necessarily strictly associated with the new mortgage. And here's what I mean. If you've got an old mortgage or current mortgage, you're paying interest, whether you refinance or not. If you are, you're going to pay property taxes, and you typically have homeowners insurance. So you're going to pay those on the old loan. You're going to pay those on the new loan. These are costs that you're always paying just by owning a home and or having a mortgage. So when are these costs paid? Well, if you're doing a new loan, the hard costs are going to be paid at time of closing, and the required soft costs for the new loan are going to also be at the time of closing. But what happens is at closing, they're all lumped into one final sum, where they'll say, okay, your total closing costs are an X amount of dollars. But if you know the difference between the hard costs and the soft costs, then that can help you structure your loan to your advantage. And I'll show you how to do that in a little bit. Okay, so how are the costs paid? Well, and why does it matter? Well, there's a few different options that you may have when it comes to getting your costs paid. So when I say costs, I'm actually going to refer to soft and hard together. Then we'll split that out here in a second. But here are your options. You can just pay for your costs with cash out of pocket. If you're purchasing a home, oftentimes the sellers will offer to pay those costs for you. If you're doing a refinance, sometimes you can roll them into the loan. In other words, you would just increase your loan balance to cover them. And then a cool trick is to take an interest rate that's a bit higher than what the rates of the day are, and then the bank will have some rebates that could cover those. So so if you take, for example, a rate that's slightly higher than what the rate of the day is, then a mortgage lender may give you the opportunity to cover some or all of your costs, depending on what the pricing is on the day. So the interesting thing is since brokers typically have lower rates, you may end up with what would be considered a normal market rate and still have all or most of your costs covered. So now one thing that's kind of interesting is to potentially look at a hybrid of all three options. I've had clients before where we've looked at what their situation is, and it actually made sense to use some of all three. So I had one client one time said, hey, in addition to my down payment, I've got an extra $900, and I'd like to pay for some of my closing costs. And okay, cool. And then he said, but it didn't make sense to have, he wanted also to get a little bit lower interest rate. So we were able to use that $900 in his favor. And then he also wanted to roll a few more costs into his loan to even get a lower rate by rolling the costs into the loan. And we ended up rolling a portion of each of the closing costs into one of those three options, and it worked out really, really well. So we always want to look at each one of those. How a no-cost option can work in your favor is a no-cost option allows you to change your mortgage repeatedly without paying fees every single time. So the question is, are there costs on a mortgage? Yes, but the bank in a no-cost option, it will actually pay those for you. So I had a client just recently that I was speaking with who said, man, I really, really, really want to refinance, but I just paid $6,000 in closing costs 9 months ago, and I don't want to do that again. And I said, yeah, that totally makes sense. I wouldn't either. So let's take a look at a no cost to see if that plays out. And as we were going through the numbers, it turns out that it made a lot of sense to actually refinance, because he was able to refinance without having to go through that whole round of $6,000 out of pocket again. So another advantage of the no-cost option is it will preserve equity. So if you're not having to, we're not talking on a no-cost rolling your fees into the loan. We're actually talking about having your fees covered by the bank. Okay, so that we've got to make sure that that differentiation is clear. So if the bank, the lender, is covering your closing costs for you in exchange for you taking a little bit higher interest rate, then you will preserve equity. You won't have to roll your loan. You won't have to roll your costs into the loan and increase your loan amount if you're doing a refinance. The other advantage is there is zero recovery time. So what is recovery time? How you know if it's worth refinancing is you take a look at how much it's costing you to refinance in hard costs versus how much it's saving you per month. So if you are spending $1,000 out of pocket, for example, or just spending $1,000 in costs, and you're saving $100 a month, then you will have recovered that $1,000 in 10 months. So we always like to look at those recovery times and make sure that they make sense. So here's something interesting is banks know statistically that you're going to refinance out of your mortgage typically well under 5 years. So most loans are not kept for longer than 5 years, even if they're a 30-year product. So the banks don't mind if they give you a little bit lower rate and charge you up front for it, because they get their money up front, right? Because you're likely, in their eyes, going to be out of that loan. Kind of interesting, huh? So the question is, oh man, Darren, how do I know what option is best for me? Well, everybody has their own scenario, their own credit qualifying, and their own their own priorities. So I would advise my clients to prioritize what's important. And when I say what's important to you, what's important financially, is it to pay off your loan as fast as humanly possible? Is it to get the lowest possible payment? Is it to get cash out? Prioritize the things that are important to you. And then that will give us an idea of what direction to go. And then how long are you estimating you're going to hold the mortgage? Yeah, it's a 30-year loan, I get it. But you may know that, you know what, in 3 years, I'm probably going to sell this property or have some opportunities that we're hoping, that kind of thing. And so knowing that what kind of window that you're going to be holding the mortgage will also help us determine what the best scenario is and let you decide what that would be for you. So then, of course, we always factor that recovery time, the cost versus savings over time. So if you know that, then you are in a much better spot to make a good decision. Okay, so on a refinance, and honestly, even on a purchase, but soft costs may actually be completely offset, and why it matters. So just really, really briefly, a portion of your taxes and insurance will be collected up front on your new loan, and generally those are put into an escrow account. So you'll have a few months of interest, a few months of taxes. Sometimes you can waive the escrow account, but this is typically how it goes. Your escrow account on your old loan will typically have a balance in it. So you're going to set up a new escrow account on your new loan, but then your old loan is going to have a balance as well. And so when you close out that old loan, whatever's in that escrow account will get refunded back to you. Then on the interest, any amount of remaining interest, daily interest on your old loan is calculated into the payoff. So if you owe, say, $100,000 at the first of the month on your loan, well, you'll also have some days worth of interest on there as well. And so your payoff will end up being $100,000 plus whatever the interest charges were that haven't been paid just yet. And usually it's we calculate 15 days worth of interest. It could be a little bit more, could be a little bit less, but in that range. And then also on your new loan, the day your loan funds, you will be charged interest from that day till the end of the month. And that interest is to be paid up front. So the month that you close, you're accounting for a month's worth of interest. Half, let's say roughly half on the old loan and roughly half on the new loan. So why does this matter? Well, because you're closing, you're accounting for the interest in that month of closing. Well, your interest will be up to date by the time you hit the end of the month, and so your first payment won't actually be due the next month. It will be due the following month. I know that can be sometimes a little bit confusing, but just know that this is where the idea of skipping a payment comes from. You're not really skipping a payment. You're just accounting for the interest at close. And then since you're all up to date on your interest, then you will not have a payment the following month, but typically the month after. So the example is you close your loan in June. You're accounting for your interest in June. Your first payment won't be due until August. Now, why does this matter? Well, if you know that this is money that's going to wash either through not having to make a payment the month following or getting an escrow account refund, then you may not want to roll those costs into your loan. You may not want to put your account up higher because you know you're just going to be moving that money around anyway. So if you're really, really on the edge about your loan balance, then pushing money or shuffling money around on that soft account or that the soft cost can really be helpful to you. The other thing you can do too is if you say, hey, I had a client one time that said, you know what? I need a little bit of cash, but not much. I only need like $2,000 because I want to finish a bathroom. But I'd also like to do a refinance, but I don't have the $2,000. So what we did was we actually rolled the soft costs into the loan. We went the other direction. And what that allowed was when this borrower got their escrow refund, they didn't have to pay out of pocket to set up the new one. So they just took that money. And then when they didn't have the payment the following month, they combined that with the money that they had saved up from the escrow refund, and voila, they ended up with right around $2,000 to finish their bathroom. So it's a way that you can move money around to get what you need on a smaller scale. And we look at all of these things, and we look at that, and that's why it matters, because it may actually make a difference to what you're trying to do. Okay, so the key is to just examine every option every single time. So there's going to be a cost scenario and an interest rate structure scenario that's going to favor your personal situation, and it might favor you, maybe it won't favor somebody else, and the timing of it may favor you. What you did last time may not favor you this time. So it really does depend on priorities, the market condition, your situation, things that are important to you. And here's the thing, is clients do not have to sit and go through every single option on their own. It's actually pretty simple to do, and we do it all the time, and it doesn't take that long. If a client comes through our doors, we will sit down and we'll go through every one of these options that make the most sense and run the numbers and let our clients make the decision, and then we move forward based on their decision. So, but again, we always look at everything, including what the market's doing, the recovery times, all those things. So the fundamental principle here is, if you structure your closing costs and the interest rate together correctly, then for your situation, you have the greatest chance of saving the most money. And just know that there are a lot of options on all of those. Okay, so let's move on to Pillar 2, the right term. Pillar 1 was by far our longest pillar, by the way, and that's the one that we get the most questions on all the time. Okay, so Pillar 2, we'll move through this a little bit quick because I don't want you to be bored. Sometimes talking about this stuff is really boring because who sits and talks about mortgages all day unless you're in the business? So yeah, kind of shows you, what my life is like, right? Just kidding. No, this is really great stuff because it really is useful if you know how to leverage it in your favor. Okay. The repayment term is just simply how many years it would take to pay off your mortgage in the minimum, if you made the minimum payments. The typical, of course, that most people hear of is a 30-year or 15-year block. But honestly, I've noticed a trend that a 30-year or a 15-year product actually can lead to inaccurate thinking, and that is, hey, I've got a 30-year term, therefore I have to hold this mortgage product for 30 years. But that is not necessarily true. You can refinance and change your mortgage situation anytime. You're not stuck in that 30-year loan unless you're just going to make the minimum payments for 30 years, right? So most people that I've talked to don't understand that there's actually other terms like 25, 20-year, 10-year, and something really cool coming up that I'll show you in just a minute. Other terms that are available. So even though your repayment term is 30 years, or it could be as long as 30 years, making adjustments by refinancing can save money over your homeownership life. So I will give you an example here of a client in just a few minutes that the refinances happened all the time, but they still ended up saving money. Okay. Remember the response, I feel stuck in my mortgage and I don't want to refinance because I don't want to restart the clock on a new 30-year loan. And that is totally understandable because let's say you're into your loan 3 years and you've finally made some headway. You feel like anyway, hey, that's 3 years. That's a long time making headway. You don't want to give that up. And that is totally cool. And so we have an amazing tool to save money, and it works really, really well. It's one of my favorite things that's come out here recently in the mortgage market. And many don't know that we actually have some loan products that offer loan terms anywhere from 8 to 30 years, and you, as the client, can pick whatever term you want. So you want to pick a 23-year or a 28-year? Great. But let me give you an example why this can be such a cool money-saving tool. So if a client has a current mortgage, they just barely got their house a year ago, and they want to do a refinance. Well, they could pick a 29-year term when they refinance and not have to restart at 30 years, or they can even go shorter. You could go 27 years if it fits inside the client's payment window. So what we do is we just calculate the payment based on the term, and the shorter we can get the term, the more money a person can save on interest. So, in fact, if a borrower started a loan with something like mortgage insurance, then a really cool trick or method that we look at is take the mortgage and drop the term, refinance out of mortgage insurance if possible, drop the term from 30 years to 25 years, and it's possible that the payment may stay pretty close to the same as what they're paying, but instead of money going to a mortgage insurance premium monthly, now it's going to more principal. So it's a really cool way to leverage and save money. And I'm going to show you a cool combination here in just a bit that can make it so you could refinance all the time. And if you get you get it right, get the combination right, you'll save money every single time. It's really awesome. Okay, let's go on to pillar 3, and that is the right product. There are many more loan products out there than you may realize, and that's totally understandable. I mean, there's lots of wholesale lenders right now that have new mortgage products. We see new products all the time to help everybody out, and each loan product has its strengths and weaknesses. You don't have to know every single strength and weakness. That's totally cool. That's our job. We stay up to date on those things. But if you use the right product for you and your current needs, then that can assist also in saving money. So what I have found over the years is as needs change, loan products that are designed to meet those changes accommodate and help out our clients all the time. So let me give you a real-world example. So a number of years ago, we had a client. She bought a home with a low down payment loan, and at the time, she had trouble qualifying on her own. And so she had a parent co-sign. Well, after a year of that, she wanted to get her parent off, and so she refinanced. And then a year later, her equity had gone up, a little bit, so she refinanced again to get out of the mortgage insurance associated with the previous loan. Whoop. And then 2 years later, as her family expanded, she wanted to finish the basement. So she went and did another refinance, and this time got a little bit of cash out. 18 months later, the market rates went down, and she refinanced again. So far, she's done 5 loans in the course of just a few short years. And then a year after that, decided to sell her current home and then use the equity as a down payment on the new place. So that's 6 mortgages in just the course of a few years. Now, you might say to yourself, that can get awfully expensive, and that would be correct. But remember, if you get the costs right, you get the product right, and you get the term right, then every single time that refinance happens, it actually moves closer to a money-saving situation and a goal-achieving situation. And she's been very, very happy with her mortgage products because they have moved with what her needs are, and it totally has made sense. Okay, so here is the knockout punch, and this is what I really, really love when we can make this happen for clients. So the combination of the 3 make what I call the perfect storm for money-saving awesomeness. So if you can get a lower interest rate than where you're at now, all things considered, at no or low cost, and a shorter term. So if every single time you did that, let's say, for example, how often could you refinance and have it make sense? You could repeat that scenario again and again and again, and every single time you'd be moving in a direction that would save you money. So, and of course, there's a bunch of different other possibilities, like the mortgage insurance thing, or what if a client has debts that are high interest they want to get rid of, or they want to increase the equity of their property by doing landscaping or improving it, those types of things. So there's all those things that factor in, but then we always funnel them, whatever the needs are, we always funnel those needs through those 3 pillars. Okay, so just because you're in a 30-year loan right now doesn't mean that there is not opportunities out there for you. And so right now, we are working with a lot of clients, and what we do is we provide a personal, complete, custom blueprint of money-saving opportunities for you. And if this is something that you'd be interested in, we would love to work something like this up for you. We'd be delighted to help you out, see if we can come up with a knockout punch for you. Now, I will say that some clients come through the door, and honestly, they're in a really, really great spot. And if we made a change, it would not save them money, and we make sure that that's clear. And so, not everybody that comes through the door is it going to work out just absolutely amazing. You might be in just an amazing spot as it is. And if that's it, great. At least you can walk away with some peace of mind knowing that there's nothing you need to do for the time being, which is fine. Okay, so when we work on our knockout punch, here's what you'll be getting. We're going to do a money-saving analysis using the 3 pillars of saving money. Okay, we'll also look at... We'll look at those 3 things. We'll filter everything through those 3 things and see if there's a way that this could be set up to save you money. We're going to do a current mortgage situation analysis. So where are you at right now in your current mortgage? How long have you had it? Where do you think you'll be? Those types of things, and help work through some of those scenarios. We will also do a complete credit analysis to see where you're at on other debts, if you have any, and where your credit scores are at, and how getting a new loan could affect your credit scores. And then we'll also do an affordability calculation. So if you're looking to buy a home, we'll help you with how much can you afford. If you are looking to refinance, we will look at what is the most money-saving scenario you can get based on what you're willing or able to afford. So those things, the money-saving analysis using our 3 pillars of saving money, we're going to do the current mortgage situation analysis, the complete credit analysis, the affordability calculation, all for the tidy price of free. Yes, we will do all of this for free. And we'll walk through all those things. If you walk away and say, you know what, I don't want to do a mortgage, or it doesn't make any sense to do a mortgage right now, that is totally cool. We just want to help as many people as we can save money. Now, I do have a little bonus. We always like to throw in a little something extra. So if you have a current home, if you take advantage of our offer to chat with us and do our full analysis, our knockout punch analysis, then we will give you a free current home value estimate. Okay? It's a $50 value, but I will tell you right now, it's not a full-blown appraisal. So it is it's a tool that we have that will estimate the value of your home given data in your surrounding area. Eventually, if you move forward, then you will want to get your full-blown appraisal. But at least you get a ballpark idea of where you're at and what direction you can move with that information. Okay, so how do you get all this awesomeness? Here it is. Fill out the brief form here on this page somewhere, and then we'll reach out to you. Just throw in your contact information. We'll reach out to you to set up a time. No obligation call. If you're a little bit skittish, you're like, oh man, I just want to kick some tires. I don't want to talk to anybody just yet. Well, that's fine. Just text us at the number 801-888-7468 and tell us you want a smart mortgage or a knockout punch. That's fine. And then we will converse through texting until you get a little more comfortable or until you walk away, which is fine. Or if you just want to get going right away, there's a link to an online loan application. Take 5 minutes, fill that out. That information will download to us. We'll schedule a time to chat with you. Again, no obligation, and to see if there's any possibility of saving you money and help you with any scenarios you might have. Now remember, no obligation, no purchase, no pressure. We just, again, if there's some awesome opportunities out there that maybe you haven't realized, that's totally cool. Then great. We want to help you realize them. If not, that's no problem either. So here it is, the Knockout Punch Mortgage, money-saving awesomeness. We want to get the right cost, the right term, and the right product. And again, how often could you repeat that scenario? All the time. Thanks again. I hope that answers a lot of your questions. I hope that arms you with some information. And let's chat. Fill out that form below. Again, take a look at all the fun disclaimer stuff. And, I really look forward to visiting with you and seeing if we can save you some money. So until next time, keep working on those angles to save money, and talk to you soon.